All right, let's dive into one of the trickiest, most misunderstood concepts in all of DeFi, impermanent loss. I know, it sounds a little intimidating, right? But if you've ever looked at those juicy DeFi yields and thought, man, what's the catch? Well, you're in the right place. We're going to break it all down, super simple, so you can get in there with way more confidence.
I mean, we've all seen them, right? Those absolutely insane yields in DeFi. It just sounds like a dream come true. You provide some crypto, you sit back, and you earn passive income. But let's be real, there's almost always a hidden catch, a risk that you really need to understand. That risk is impermanent loss, and it's the puzzle we are going to solve together today.
So let's just start right at the beginning. Before we can even think about strategies to protect ourselves, we have to really get a grip on the risk itself. So what is impermanent loss, really?
Okay, so here it is, the big definition. In a nutshell, impermanent loss is just the difference in value between two scenarios. Scenario 1, you just hold your tokens in your wallet. Scenario 2, you put those same tokens into a liquidity pool. That gap, the difference between what your tokens would have been worth versus what they're actually worth in the pool, that's impermanent loss. It's that simple. And what's really key to understand here is this isn't about money just vanishing from your account. It's what you might call an opportunity cost. It's the potential value you missed out on because you decided to provide liquidity instead of just holding. This simple comparison is the absolute core of this whole thing, and we're going to keep coming back to it.
So how does this difference in value even happen? It's not some kind of dark magic, it's just mechanics. Let's walk through the whole process, step by step, to see how an automated market maker, the engine of a decentralized exchange, or an AMM, actually creates this whole effect. Okay, so it all kicks off when you deposit your tokens, usually in a 50-50 split by value. Then the market does what it does. Prices change. So when one of your tokens becomes more valuable out there on the open market, traders are going to swoop in and buy the cheaper version from your pool to sell it for a profit. This forces the AMM to rebalance itself to keep that 50-50 value. And what's the result for you? Well, you're left with more of the token that went down in price and less of the one that went up. And the reason it's called impermanent is because, hey, if prices swing back to where you started, that loss can literally just disappear. It only gets locked in if you pull your money out. Theory's one thing, but let's make this totally real. Seeing the actual numbers is what makes it all click. So we're going to look at 3 completely different scenarios to see exactly how these price changes can impact your bottom line. First up, let's look at a pretty small price change. Imagine you put in $1,000 worth of assets. If one of those tokens goes up by 10%, well, if you just held them, your stack would be worth $1,050. But in the pool, after all that rebalancing, it's worth $1,048. The difference, your impermanent loss, is just $2. In a case like this, the trading fees you earn would almost for sure cover a tiny gap like that. No big deal.
Okay, but now look at this. This is where it really clicks for a lot of people. This is the aha moment. What if that token doesn't just go up 10%? What if it doubles? 100% jump. Suddenly things look very different. If you had just held on, your initial $1,000 would now be worth $1,500. Not bad. But in the pool, you're sitting at $1,414. That's a difference of $86. So here's the key takeaway, right? The bigger and wilder the price swing, the bigger that potential impermanent loss gets. And this right here illustrates the absolute safest way to go. What happens if the prices barely change at all? Well, when you pool 2 stable coins, like USDT and USDC, their values are both pegged to the US dollar. So with almost no price movement, the value in your pool stays pretty much identical to the value of just holding. This is exactly why stablecoin pairs are such a fantastic, low-risk starting point for anyone new to providing liquidity.
Okay, so we get the problem now, and we've seen it play out with real numbers. So what do we do about it? This is the most important part. Let's get into the toolkit and see how you can build a real strategy to protect yourself. I want you to think of this like your personal checklist for safer DeFi farming. It all starts with the assets you choose. Stick with stablecoins for the lowest possible risk. Or maybe pick major, less volatile tokens like Bitcoin and Ethereum. Then, it's all about your strategy. Keep an eye on your positions, maybe think about shorter timeframes, and definitely don't put all your eggs in one basket. Diversify. And finally, you can even look for platforms that offer built-in IL protection to give you an extra layer of safety.
And this quote just nails it, doesn't it? It's not about finding some magic button that makes all risk disappear. It's about using smart strategies to manage and shrink that risk, so the rewards you're earning from fees and yield farming have a much, much better chance of coming out on top.
So let's bring this all home and lock in the key insights. You know, the goal here wasn't to scare you off from DeFi. It was to arm you with the knowledge to jump in, but in a smarter, safer way. It's really all about making that mental shift from fear to strategy.
Okay, takeaway number one, and this is the most important one. Impermanent loss is not money just disappearing from your wallet. It's an opportunity cost. It's simply the difference between your pool's value and the value you would have had if you had just held on.
Number two, remember that volatility is the engine that drives impermanent loss. The more dramatically those prices move apart, the bigger the IL. And that's exactly why stablecoins, which hardly move at all, are your lowest risk option, period. And finally, number three, never forget that IL is only half of the story. On the other side of the equation, you have the trading fees and the farming rewards you're earning. These are specifically designed to pay you for taking on the risk of IL, and in a lot of cases, they can make providing liquidity way more profitable than just holding. So let's end with this. Let this be your guide as you explore DeFi. Impermanent loss isn't some monster hiding under the bed. It's just a known, predictable factor in the system, and now that you actually understand how it works, you have the tools you need to manage it. Thanks for tuning in to This Explainer.